This is Andrew Stotz of Stotz Investment Research looking at U.S. interest rates over the long term. Now, there's a few points that we can see. First of all, this chart shows the blue line, which is the long-term U.S. Treasury rate, and the yellow line, which is the short-term rate. Remember that the Fed can only control the yellow line, and every time they bring the yellow line down, they hope they're bringing the long-term rate down at the same time. That's the tool that they have. So there's a few things that we would understand from this chart, and I did another chart that goes a lot longer term, which I'll look at later. But the first thing is that short-term rates have been at 0 for 7 years. That's an exceptionally long time, and never in the history of the Fed have we seen 0 rates for this long. The second thing we can see from this chart is that they achieved the goal, which was to cut long-term rates nearly in half, from about 5 to about 2.5 at the bottom of the cycle. And that's the objective, is making sure that the long-term rates and people's expectations about interest rate and inflation are low. Now, the next thing we can see is in the most recent period, a tick up in the interest rates. And what I believe is that's the beginning of a Fed normalization policy. Why were the rates low for so long? Well, we just came out of the financial crisis in 2008. The Fed wanted to make sure that they were stimulating the economy, and a lot of shifts were happening in the U.S. economy, which made the market less responsive to that low interest rate environment. So we didn't see fast inflation, and we didn't see high growth coming out of the U.S. during that period. And the result is that they just kept that rate as low as they could for as long as they could. Now, normally that causes massive disincentives in the overall economy by giving money to people at a really cheap rate. And of course it did in the US government, where the government was happy to continue to borrow a lot of money at almost no rate, at very, very low rates. So now let's talk about normal. What is a normal long-term, what is a normal short-term rate over the long term? My calculation since about 1990 is that a short-term rate of about 2.7 is the long-term average. So we could say 2.5 or something like that. And what this would mean is that if the Fed were to normalize, it means that the interest costs would rise by 5 times. Now, an interest cost of 5 times, an interest cost increase of 5 times. Imagine if interest costs were 1 and they went up to 5. They've been increased by 5 times. That would cause a huge increase in the interest expense for the federal government, which is in a lot of debt, as well as companies and other organizations, state governments and the like, that would have to pay a higher rate. Now, they're not all borrowing at the short-term rate, so the rate impact wouldn't be 5 times for everybody across all terms. But what we would see is a maybe 2 times rate rise at a minimum if they normalized, if someone was borrowing on the long-term bond. Right now, long-term bond is about 3%, let's say 3.1 in this chart. That could go up to maybe 5 to 6% over time. And that's still a pretty massive increase. So that gives you an idea of what's happening with interest rates and where they could potentially go. Have a great day.